So it's 12:01. Let's go ahead and begin. So good afternoon and welcome everyone. Many of you have joined us throughout this webinar series and we're grateful to have you all. And we are now going to begin session 6 of the webinar series, Making WVABLE Work for You, presented to you by Disability Rights of West Virginia and WVABLE. So my name is Roxanne Clay, and I am with the West Virginia State Treasurer's Office and the WVABLE Savings Program, which stands for Achieving a Better Life Experience in West Virginia. And I will serve as the moderator for today's session. And please also welcome Tiana Hardy and Roy Mallory with Disability Rights of West Virginia, who will serve as our co-hosts for today's session. For those of you that are not familiar with WVABLE, WVABLE is a savings program that allows individuals with disabilities to save and invest without jeopardizing their eligibility for federal benefit programs such as SSI or Medicaid. Today's session is titled Preparing for Your Future, Special Needs Trust and WVABLE. It is the 6th of 8 webinar sessions in the series that is being held every Tuesday at noon through December the 8th. If you haven't already done so, you can still register for the upcoming sessions, and we've included the webpage in our chat box. But before we get started, let me mention a couple reminders. All attendee microphones have been muted to eliminate any background noise. We encourage attendees to ask questions, and we ask that you include your questions in the chat box. We will save all questions until the end of today's session. Closed captioning and a sign language interpreter are available for all sessions. You can find and click closed captioning at the bottom of your screen. And for the sign language interpreter, you can find the video tile titled Sign Language Interpreter Ashley, right click and choose Pin Video. And thanks to Dolores Brown and Ashley Turley for their ongoing support in providing ASL and closed captioning through our webinar series. And for technical issues, please include a message in the chat box that's being monitored by our co-hosts and myself. 1 hour of social work continuing ed has been approved for this session. For attendees seeking social work CEs, please ensure that you've emailed wvable@wvsto.com. Let us know that you are requesting social work continuing ed credit for your attendance. Include your full name and the email address. Also, at this time, please include your name in the chat box. Toward the end of the session, a link to the survey will be included in the chat box, and that will also need to be completed. We want to thank West Virginia University Center for Excellence in Disabilities for sponsoring the social work CEUs and making these available to our attendees throughout the webinar series. Additionally, we want to take a moment and recognize our co-host, Disability Rights of West Virginia, our planning committee, and all the scheduled presenters, as well as the WVABLE Advisory Board members for their ongoing support of WVABLE Savings Program. As you can see in the slide, the members are made up of numerous organizations and entities that serve and or advocate for people with disabilities. They play a very important role in informing individuals around the state about the program. And of course, the WVABLE program wouldn't be possible if not for the work of State Treasurer John Perdue. He supported the many West Virginia families and advocacy groups that wanted the program in our state. He, his staff, the families and groups worked hard to bring this program to West Virginia. And our state became one of the first in the nation to pass local ABLE legislation in response to the passage of the Federal ABLE Act. So at this time, let me introduce our presenter for today's webinar session. And her contact information is being included in the chat box at this time as well. Anna Price, attorney with Jenkins, Fenstermaker, PLLC. Anna focuses her practice in the areas of simple and complex estate planning, estate administration, tax, corporations, and probate litigation. Working with a variety of clients, Anna has developed a skill set and relationships to plan for and administer estates of all levels. Anna received her Bachelor of Arts degree in elementary and special education from Marshall University in 2007. She then went on to graduate from West Virginia University College of Law in 2010. She began her legal career with Huddleston Bolin, LLP, and Ansbach, Meeks, and Ellenberger, LLP. But in 2016, Anna began putting her knowledge of West Virginia estate planning to work for Jenkins, Fenstermaker, PLLC. In 2018, Anna's excellence as a top-rated estate planning lawyer in West Virginia brought her national recognition in Super Lawyers as a rising star in 2018, 19, and 20. So Anna, it's an honor to have you presenting today as part of our webinar series. And we just thank you for the opportunity. We have folks that send questions to WVABLE quite frequently. So this is just a wonderful opportunity for families to learn about the different trusts that you're going to be sharing today. And then also the piece about how special needs trusts and WVABLE can complement each other. So with that said, I'm going to hand it over to you.
Thanks, Roxanne, and thanks everyone for having me. This is quite an honor. As a former special education teacher, there is no question that I have a passion for helping people with disabilities, and it has become an integral part in my practice as an estate planner. A lot of people ask me how I got from one to the other, and the jump really isn't as large as some people think. So I am still able to help people solve problems and help them reach their goals in different ways. So a big part of estate planning, of course, in addition to writing wills and powers of attorney, is helping someone with their financial health and well-being, and that's helping everyone. So people of every demographic, and it was an easy transition for me to take on the representation of persons with disabilities or family members of someone with a disability that they wanted to plan for. So it's an honor for me to be here, and thank you very much. Today's objectives: we're going to distinguish supplemental needs trusts and West Virginia ABLE accounts. So since I know that this is your webinar number 6 of 8, I'm going to focus more on the trust side than the ABLE accounts, because I know that you have already had quite an education in that. But for those of you who were not able to attend the prior sessions, I will give a brief overview of West Virginia ABLE and what that is. Additionally, I'm going to explain where to go to set up each one of those, an ABLE account or a supplemental needs trust. And you'll hear me say supplemental needs trust and special needs trust interchangeably. We generally call them either, so both terms work. And then finally, I want to talk to you about determining when you need an attorney, because here in West Virginia especially, we have a lot of options where people can represent themselves. But sometimes I think that the job can be too large and that an attorney may be needed. So I understand for social work CEUs that you need some pretest questions. So I am going to move through here, and you have to bear with me. I am not a technological person. I'm more of a paper person. So I am going to be messing with some papers down here below the camera. So if you hear that, I apologize. So pretest question number 1, true or false? A person can have a supplemental needs trust and an ABLE account. And if you won, you can go ahead and list your answer in the chat box. Question number 2, true or false? A person must hire an attorney to set up an ABLE account. And question number 3, true or false? Asset-based government benefits are always repaid from supplemental needs trusts at the death of a beneficiary. Okay, We'll move forward and we'll revisit these questions at the end to see how you did, see if you've learned something, or if you have any questions about those questions or anything else you hear in today's presentation. So anytime you are doing a type of estate planning or financial maintenance, it can be really challenging, even in the best of times. But when your estate plan or your financial management needs to consider someone with special needs, or you are someone with special needs, it can become very complicated. Many individuals with disabilities rely on government benefits such as SSI or Medicaid. And those are what I refer to throughout this presentation as asset-based government benefits. There are additional asset-based government benefits, but those are the two that we're mainly going to be talking about today. For families who have a member that is receiving these asset-based government benefits, it can be really difficult to plan. So we have had the opportunity in our country for 25 years to use a supplemental needs trust, and even more recently, in 2014, we have been able to use ABLE accounts. So in 2014, Congress passed the Achieving a Better Life Act. And so that is ABLE, and it allows for the accrual of savings for a person with a disability without impairing any of the eligibility for those government benefits. So a lot of times my clients will say, nothing can be in my child's name, or nothing can be in my name because I have a disability, or because my child is receiving asset-based government benefits. And these are some exceptions and some ideas to allow additional resource funds for them. So ABLE accounts are sometimes referred to as 529As because they are modeled after 529 education accounts. So if you've ever heard of a 529 plan, this is different. This is a 529A plan, but they are structured similarly. West Virginia launched WVABLE in 2018, I think slightly after my neighbors in Ohio did here, and the plans seem very similar. So who qualifies for an ABLE account, which is one of these savings accounts? And the people that qualify must reside in West Virginia. They must have an onset of disability before the age of 26. So this is not a nursing home planning mechanism that a lot of my older clients contact me about. That type of disability that occurs later in life is not appropriate here for an ABLE account. And any one of the following criteria must be met. You must be currently eligible or entitled to receive SSI and or SSDI due to a disability. Have one of the conditions listed on the Social Security Administration's list of compassionate allowances conditions, or meet the Social Security's definition of disabled. So that's who can have an ABLE account for their benefit. Okay. So when we talk about who can have an ABLE account for their benefit, we are saying that because that individual with a disability can only have one ABLE account. So if you have a grandchild with a disability who qualifies for an ABLE account, you cannot set up an ABLE account as well as their parents, as well as a neighbor or a fundraiser. That is not what an ABLE account is for. So a person can only have one ABLE account, but anyone can make post-tax dollar contributions to that ABLE account. And funding an ABLE account is free from gift tax reporting. So I just want to take a little sidebar here to talk a little bit about gift tax. And I promise I'm not going to talk too much about that. Hopefully you're having lunch right now and you don't fall asleep right in your lunch as I talk about taxes. But gift tax is not the same as income tax, okay? So gift tax is a tax that really only applies if you make a gift to someone or an eligible gift tax entity of over $15,000 per year. If you're married, you and your spouse can make a gift of $30,000 without reporting it. When you report gift tax, you don't necessarily pay gift tax. That amount just gets taken off your unified credit amount, which is the amount that you're allowed to die with in the United States without paying estate tax. So there's our third tax in this conversation. So estate tax does not currently kick in unless your estate exceeds $11.58 million. So unfortunately, most of us in this area do not have an estate tax problem, although we do have some members of our communities with estate tax problems. So gift tax may not be a huge concern for you when deciding whether an ABLE account or a supplemental needs trust is necessary. So, but if you are in that range where you do have to worry about estate tax and gift tax, and of course that number could always change and go lower, then an ABLE account, it's important to know an ABLE account is free from any gift tax reporting. So you can gift more than the eligible amount if you're gifting more to that person. As of May 2019, contributions to the ABLE account may qualify as a deduction against state income taxes up to the amount of contribution for that tax year, and may carry over deductions for excess contributions for up to 5 years. So that's very similar to the 529 accounts, 529 plans, but there is a benefit to contributing to a West Virginia ABLE account. I will say that currently 44 states have ABLE accounts. So they're getting increasingly more popular. And I will also say that, you know, who can create an ABLE account, and I think that we're going to talk about that a little bit here in a moment, but the person with the disability can create the ABLE account, and also an authorized legal representative of that person. So a parent, guardian, conservator, or a power of attorney can also create that account. So what can ABLE accounts be used for? This is going to be an important thing to evaluate when you're deciding which or what combination of ABLE accounts and supplemental needs trust you want to use. So as we mentioned before, the account is not subject to tax, that's income tax, so long as it is used for qualified disability expenses. So what makes up these QDEs? Housing, basic living expenses, transportation, employment training, education, assistive technology, personal support services, healthcare, financial management, legal fees. We always remember that lawyers wrote some of this legislation, so they always make sure to include themselves on the expenses. I only poke fun at my colleagues in this profession. But so all of those items are appropriate uses of the ABLE account. So let's move forward a little bit. So there are some limits to ABLE accounts. The maximum amount affecting benefit eligibility is $100,000. The maximum annual contribution is $15,000 from all sources. So that's another reason that maybe gift tax doesn't apply here, because you would have to give more than $15,000 to the ABLE account, and in addition to that $15,000, an amount exceeding that for the benefit of that person with a disability. And as of May 2019, West Virginia ABLE account assets are not subject to Medicaid payback. However, ABLE account assets are subject to estate recovery, which applies for people who receive Medicaid benefits for nursing home care. So again, that's for the more elder or senior population. A couple additions here. A disabled person who's employed may contribute earnings from employment up to an amount, a disabled person who is employed may contribute earnings from employment above that maximum and up to an amount equal to the federally defined poverty level for a one-person household. In 2020, this was $12,490. So that is going to conclude my discussion of defining ABLE accounts because I know that you have heard this, and I would like to devote the majority of my presentation to talking about supplemental needs trusts because I think that this is your only webinar in this series that will discuss these types of trusts in depth, and I want to make sure that you are getting a full understanding of these trusts so that you can be prepared to make decisions on what avenue you should take for your financial well-being. So supplemental needs trusts were first created as a part of OMRA in 1993 and allowed, and later there was a change to allow an individual to set up a supplemental needs trust for themselves. So a supplemental needs trust is always considered a spendthrift trust. A spendthrift trust is a trust that is protected from creditors for the most part, and we'll talk about some differences in that. And it also keeps the beneficiary of the trust from spending the money inappropriately or controlling how the money is spent. So we'll talk about that as well because someone has to hold those purse strings for that. Anyone with a disability can be the beneficiary of a supplemental needs trust. A person with a disability can have an unlimited number of supplemental needs trusts. So this is different than the ABLE accounts because here a grandparent, a parent, a friend, anyone can set up a supplemental needs trust for a person with a disability. There's no limit on how many they can have. Often clients will ask me, can we just use the same trust? And there may be pros and cons to whether you should use the same trust or use a different trust. And I recommend that you speak with an attorney before deciding that because there could be tax consequences or asset protection benefits to not using that trust. Also different than the ABLE accounts. There are no deposit limitations and there are no limitations for how much can be in the trust. So the trust can grow to whatever extent it needs to, or it can. The assets will be invested and can be used for the benefit of that beneficiary. So long as the trust assets are used correctly, the assets will not affect asset-based government benefit eligibility. This is what makes being a trustee of a supplemental needs trust very, very difficult. So it's important before you take on the role as trustee of a supplemental needs trust that you understand exactly what assets can be used for and what they cannot be used for. So what can they be used for? Out-of-pocket medical expenses, personal care attendance, education, recreation, and vehicles. Remember, we talk about special needs trusts and supplemental needs trusts because these trusts are used to supplement, not supplant, the benefits that the beneficiary is already receiving. If the trust is used to pay for certain non-qualifying expenses, such as food or shelter costs, those amounts may count as income to the disabled individual, and this could adversely affect eligibility for those asset-based government benefits. So for that reason, let's see. For that reason, you want to avoid using supplemental needs trusts for things like groceries, food, restaurants, housing costs, including rent, mortgage, property taxes, utilities, homeowners, or HOA dues. You never want to make cash distributions out of a supplemental needs trust because it's too difficult to trace where cash goes and what it's for. So all of these things are extremely important to review regardless of what type of supplemental needs trust we're dealing with. There are primarily 3 types of supplemental needs trust, and hopefully we'll be able to get through every single one today. So there's a first-party supplemental needs trust, a third-party supplemental needs trust, and a pooled supplemental needs trust. So let's start with that first-party supplemental needs trust. This is probably one of the newer supplemental needs trusts to the block. Well, sorry, let me back up here. So what type of supplemental needs trust do we need, and how do we determine that between the 3 supplemental needs trusts we're talking about? Well, here are the questions that you need to talk about with your lawyer who is going to assist you in setting up this supplemental needs trust. Who is going to be the person that funds the supplemental needs trust? Is it going to be a family member of a person with a disability? Is it going to be a person with a disability? Is it going to be an unrelated party? Is it going to be an estate or a different trust? Who is going to control it? Who will the trustee of that supplemental needs trust be? And what types of fees do they charge? What types of management experience do they have? Who will it go to at the beneficiary's death? So this is generally something that's written into the trust. Occasionally there can be a power of appointment, but that is going to determine what type of supplemental needs trust is needed. How will the income in the trust be taxed? So again, we're dealing with taxes here. One myth I'd like to bust right here is that supplemental needs trust, or we often hear that trusts are taxed at the highest bracket. That's not necessarily true. A trust has a more compressed bracket, which means that it gets to higher tax brackets sooner, but is not necessarily taxed in a higher bracket. So that's something to consider as well when you're looking at the taxability of a trust. Will contributions to the trust be subject to gift tax? There we are again with gift tax. So some types of supplemental needs trusts funding does require a gift tax return. Again, only if it's over that $15,000 mark or $30,000 for a married couple. Some do not qualify as a gift in accordance with the Internal Revenue Code. Will disbursements be allowed after a beneficiary dies? That's another difference within these supplemental needs trusts. And are trust assets exempt from creditor claims? So there's 2 types of creditor claims that we're thinking of in this. We're thinking of creditor claims during the person's life and creditor claims after death. So 2 types of creditor claims here, and we will talk about these as we move forward. So now we'll get on to first party supplemental needs trusts. Like I said, first party supplemental needs trusts are newer to the game. They were created under the Special Needs Trust Fairness Act in 2016, and they are created by a beneficiary with a disability. So this type of supplemental needs trust is authorized under Code Section 1396P, parentheses D, parentheses 4, parentheses A. So sometimes it is called a D4A trust. Currently, this trust only works for an individual under the age of 65 years old who meets the Social Security Administration's definition of disabled. Because the person with the disability is setting up this trust and they're setting up for their own benefit, this trust is gift tax free. So even if you contribute more than $15,000 per year to the trust, there is no gift tax return required. A first party supplemental needs trust is a form of a self-settled spendthrift trust. So again, the beneficiary does not have unfettered access to the assets. It is controlled and limited. And in addition to the benefits available to all supplemental needs trusts, funding of a first party supplemental needs trust can be gift tax free. Anyone can control it, but only the beneficiary can fund it or benefit from it. So one thing that we want to be sure of is if this trust comes into play. We see this a lot when a beneficiary with a disability receives a settlement from a court. They receive an inheritance that the person who passed away did not plan for them having a disability or receiving asset-based government benefits. And this is the fix for those people. If they're suddenly coming into an amount of assets that they cannot have, that would affect their eligibility negatively, then a first-party supplemental needs trust may be the best option for them. So it may or may not be exempt from creditor claims, and so that is because this is still part of the beneficiary's estate for claim purposes after they pass. Generally, these trusts are pretty safe from creditor claims during life, although there are certain exceptions to that. The income is taxed to the grantor or the creator of the trust. So this is going to be under the same income tax bracket as that person with the disability. Upon death, and this is probably the most negative element of a first-party supplemental needs trust according to my clients who are evaluating this option, the trust balance is subject to a Medicaid payback for expenses on behalf of the beneficiary. So it is important to note that these assets do go to pay Medicaid first. There is a payback provision here. If there are assets left over in that trust, the beneficiary can designate where those go. So it could go on to their children, it could go on to other family members, or it could go on to charity. Third-party supplemental needs trusts are probably best case scenario, in my opinion. Some may have other opinions, but a third-party supplemental needs trust is actually created by anyone other than the beneficiary. So that's the number one good thing about this. Someone has decided to create something for you and give you this benefit. So the beneficiary would be a person of any age. So you don't have to be under 65 here. You can be any age who is permanently and totally disabled for the purpose of SSI eligibility. Anyone except for that disabled beneficiary can fund the trust, but these contributions are subject to gift tax. Remember, that may not affect you as a contributor, but it could. The beneficiary and his or her spouse are also prohibited from controlling these assets that are exempt from the creditor claims. So that person cannot be the trustee, okay? So that person cannot be the trustee of this trust. All income earned on a third-party supplemental needs trust is taxed as a non-grantor trust, which means that it's going to be taxed as the trust and not as the individual. This is where it gets into a higher tax bracket. So it's not necessarily true that it's going to be a higher tax. You will hear that. That is a myth. So when you hear people say trusts are taxed at higher rates, that is a myth, okay? You just get to a higher tax bracket sooner. So do not let that be the reason that you don't choose a supplemental needs trust. Anytime there is a third-party trust, meaning that the grantor or creator of the trust is someone other than the beneficiary, you can really offer asset protection. And this is even aside from a supplemental needs trust. It could just be a trust for asset protection, period, that you would want. Now, a supplemental needs trust is going to need additional language about what those assets can be used for. That still qualifies under our prior slide where we talked about that. But any trust can be an asset protection trust for a beneficiary so long as it's set up by someone else, is irrevocable, can't be modified or terminated unilaterally, and there is an unrelated trustee. So here it can be a related trustee, but someone else, a third party, must hold those purse strings for the beneficiary. So the cool thing about these third-party supplemental needs trusts is if the beneficiary is in a car accident and gets sued above the terms of their insurance, this trust is not accessible to creditors. If the beneficiary, heaven forbid, files bankruptcy, again, this trust is not subject to bankruptcy. If the beneficiary of this trust gets a divorce, the assets in this trust are not considered part of the marital estate to be divided in a divorce. So there is quite a bit of asset protection built into these third-party supplemental needs trusts. So examples of when these third-party supplemental needs trusts come into play in my realm are usually when somebody comes in and they say, I would like to leave a portion of my estate to this person that I love and care for very much. However, they are currently receiving asset-based government benefits. How can I leave something to them so that they continue to be cared for, but they don't lose that eligibility? And the third-party supplemental needs trust is usually the option for that. So these assets are going to come from someone else. Not necessarily at death. You could also fund it during life if you had additional monies that you wanted to fund for someone. A third-party supplemental needs trust would be a great way to do that. And there is no Medicaid payback here with a third-party supplemental needs trust. So it's a good option to have, but someone has to be willing to give you some assets or give some assets for your benefit. But we enjoy writing third-party supplemental needs trusts because we know that those will be great benefits to beneficiaries in the long run. And the third type of supplemental needs trust that we are going to talk about today are pooled supplemental needs trusts. So I deal with these much more infrequently because you don't always need an attorney to set up pooled supplemental needs trust. A pooled supplemental needs trust is a collection of first-party supplemental needs trusts. So a good we had pre-test, and we're going to have post-test questions. So a mid-test question, which I guess is not required for your CEUs, would be, could a beneficiary of a pooled supplemental needs trust set this up after the age of 65? And of course, the answer would be false. No, they could not, because these are first-party supplemental needs trusts. So pooled special needs trust collections of first-party, not third-party supplemental needs trusts, and the pooling of the assets allow for greater flexibility and opportunity for investment. Separate accounts are maintained for each supplemental needs trust for the sole beneficiary or sole benefit of that beneficiary. And this type of trust, like the other first party, are called D4As. These are often called D4Cs. There is no age, oh, I'm sorry, I gave you some wrong information. There is no age restriction on a pooled supplemental needs trust, but a pooled supplemental needs organization can control it. You might want to check. I really am not sure on that 65 age limit, whether a pooled supplemental needs trust could be used for Medicaid nursing home purposes. I would think not. So I'll get back to you on that. In some ways, pooled supplemental needs trusts take on different characteristics of the other two supplemental needs trusts. So like third-party supplemental needs trusts, a person can be the beneficiary, but like the first party, only the beneficiary can fund the supplemental needs trust, making the contributions gift tax free. So remember, when you're funding a trust for yourself, there is no gift tax there, and all first parties trusts are going to be funded for themselves. Control of trust assets is wielded by a nonprofit pooled trust organization for pooled supplemental needs trust. Assets may or may not be exempt from creditor claims. Again, this is like the first party supplemental needs trust. The income earned in these trusts is taxed to the beneficiary as a grantor trust. So again, this is going to go back out to the beneficiary's tax bracket, whatever that may be. It is subject to Medicaid payback at the death of the beneficiary. So just if you're keeping tabs here, the only one of these trusts that is not subject to a Medicaid payback is that third-party supplemental needs trust. In some cases, the pooled trust may retain a portion of the remaining assets, while in others, they may pass on as directed by the document. There are organizations that do pooled supplemental needs trusts in West Virginia. Commonwealth Community Trust, who I've worked with a few times, and New Leaf National Foundation are both organizations that work with West Virginia pooled supplemental needs trusts. So when do pooled supplemental needs trusts come into play in my line of business? Usually, if we have a trust, a first party supplemental needs trust that does not meet an asset limit for a corporate trustee, or the beneficiary does not have anyone that they trust to serve as a trustee, we often refer them to pooled supplemental needs trusts, where they can receive a third-party trustee and someone can monitor and manage those assets for them. So pooled supplemental needs trusts, like I said, I work with these much less. You don't have to have an attorney, although it may be recommended. Generally, the companies, these nonprofit trust organizations do provide for their own trust agreements and have their own forms and information that they want you to follow. There is less flexibility in the terms with those trusts. Overall, supplemental needs trusts are not very flexible types of trusts, but pooled supplemental needs trusts have even less flexibility. Oftentimes, there may be some organizations out there that have more flexible terms, but the ones I've dealt with have been more rigid. So let's talk about some of these differences in ABLE accounts and supplemental needs trusts, because we've talked about ABLE accounts, we've talked about supplemental needs trusts. So ABLE accounts are easier to set up and low cost because you don't need an attorney. You can set those up on your own. Whereas a supplemental needs trust probably requires an attorney, especially if it's going to be recorded. ABLE account, in an ABLE account, the individual with the disability is the owner and the beneficiary of that trust. With supplemental needs trust, it's very uncommon for the person with the disability to be in any type of control. There's generally a third-party trustee there. However, in some cases, they can still be the grantor or creator, and they can definitely be the beneficiary. In ABLE accounts, not everyone with a disability is eligible for an ABLE account. Remember, you have to have that onset of disability before the age of 26. You have to be a resident of West Virginia, although there are other programs in other states. Supplemental needs trust, there is probably one for everyone. In fact, like the ABLE account, so this is a similarity, you don't actually have to be receiving benefits. You can just be eligible for them, or maybe not eligible, but concerned that there may be a need in the future. I recently met with a family who they have a son. He's 17, getting ready to turn 18, and their concern was that he doesn't receive any benefits now, but he may receive benefits in the future, and he may qualify. They've never really looked into qualification. So we used what we call a backup supplemental needs trust to give him the least restrictive option possible. But if he needs that supplemental needs trust, it is there in the event that he ever does need asset-based government benefits. In an ABLE account, contributions are limited to $15,000 annually, or $27,490 for the working beneficiary. And for supplemental needs trusts, there are never any monetary limits, but there may be some gift tax reporting requirements. Choosing between an ABLE account and a special needs trust is easy when someone is ineligible for one or the other. So if you have a beneficiary whose onset of disability was after age 26, it's going to be obvious that their need is for a supplemental needs trust. Whereas if you have a beneficiary who is inheriting assets inappropriately and needs a place to put it, it's under $15,000, it may not be cost effective to consider a supplemental needs trust, and an ABLE account may be more beneficial. So it can be more difficult to make the decision when a beneficiary is eligible for both types of trusts. So when do you use both? Well, I think that ABLE accounts and supplemental needs trusts can both be used for long-term accrual and growth of assets. Broader spending power under the ABLE account. Supplemental needs trusts for those sudden lump sums of assets that come in or assets that are over the limits. And trusts can be amended for distributions to ABLE accounts. So ABLE accounts have much to offer as savings tools for disabled beneficiaries. They're easy to set up, low cost. Supplemental needs trusts, again, use the assistance of an attorney. And with an ABLE account, the individual maintains ownership, which might be important to some beneficiaries. In West Virginia, ABLE account holders can choose from 5 different investment options and may revise investment selections up to twice a year. They're tax advantaged accounts, and the growth is taxed only if the disbursements are not spent on those qualifying disability expenditures. Significantly, an owner or beneficiary can use the ABLE account for food and shelter. These things cannot be paid from a trust. Conversely, with that trust, there are no limits on how assets could be invested. So trustees of trusts are generally protected by a prudent investor rule, which means that as long as they are making investments in good faith and doing the best that they can, even if the investment is not successful, that they are indemnified and released from liability in that. Now, if they do something intentionally harmful to the assets in the trust, they are not released and indemnified. But that may be a broader option for trusts rather than the ABLE accounts. Again, Medicaid payback is going to be another consideration for which account and what combination of accounts or plans that you want to include. So if the beneficiary is receiving Medicaid and there is a question about payback, an ABLE account may be a better option because the only Medicaid payback in an ABLE account is that estate recovery. But again, it depends if the beneficiary qualifies for that ABLE account. Generally, when I'm advising my clients on which to use, I'm looking at those questions from the slide toward the beginning of our program where we talked about, which trust is appropriate, and also, what the age, what the abilities of that beneficiary are. And there's a great chart that West Virginia ABLE has. Perhaps we can share that link in the chat box sometime. But there is a really great chart on West Virginia ABLE that compares WVABLE to special needs and pooled trusts. There are a couple of things on here that I think may be a little misleading about the trust as far as the taxes go. Like some people would see gift tax and shy away from the option of a trust, and unfortunately without 11.58 million, gift tax doesn't really apply to most of us, and those income tax brackets can be a little misleading, saying that trusts are taxed at a higher rate. But generally, when I am advising my clients on what's appropriate, I want them to explore the options of both. I have a lot of clients who come in and say, I receive asset-based government benefits, but I also have a job and I'm making too much money and cannot stay below my limits. An ABLE account is a great place to put those extra earnings that you are making. Or if somebody wants to give you some money, but it doesn't support the additional costs of supplemental needs trusts, including trustee fees or including the preparation for it. So because you have to go to an attorney, it can be more expensive. So in those instances, we always recommend the ABLE accounts to clients. But most of the time when people are coming to me, they have already decided that the ABLE account may not be their best option. So we look at the different types of supplemental needs trusts and determine what could be best. So, and that really hinges on whose money is funding the supplemental needs trust. If it's the person with a disability, we're looking at those first party options. If it is not the person with the disability, we're looking at that third party option, which is always the favored option in that way. So I know that that is a lot to consider. A lot of people who talk about, who hear me talk about trusts, immediately their palms start perspiring and they get a little nervous because of that word trust. But I promise that trust can be extremely beneficial to people with or without disabilities. When people are coming to me, I keep in mind that not everybody has been to a lawyer before, and not all lawyers are the same. I will also add, so when you're coming, be sure that you are, considering that we are here to help you, and be sure to be open and honest with everything, because sometimes I think that's where we miss the opportunities for supplemental needs trust, when people aren't being forthcoming with us that a beneficiary that they want to list is on asset-based government benefits. The number one takeaway for today for me is to consider using ABLE accounts and supplemental needs trusts in conjunction with each other. They are not the same. They do different things, and using them together will provide you with the maximum benefits that are available to you. So post-test questions here. True or false? A person can have a supplemental needs trust and an ABLE account. Hopefully all of you get this one right. Okay, question number 2, true or false, a person must hire an attorney to set up an ABLE account. And finally, true or false, asset-based government benefits are always repaid from supplemental needs trust at the death of the beneficiary. I want to thank you guys for having me today, and I'm going to hand this back over to Roxanne here in a second, because I believe that everyone needs estate planning and everyone needs a will, and that is always my mission. I want to let you know that I have some general handouts on estate planning and some questionnaires to help you get started with estate planning more quickly and more easily, and I will be happy to provide those via email. My contact information should be making its way to the chat box, and it should also be on your screen. Please don't hesitate to reach out to me if you have questions. We are always happy to help folks as they navigate through some difficult times. Thank you so much.
Thanks, Anna. That was incredibly helpful. I took notes. I learned a lot today, but I'll definitely be referring back to my notes. We did have a couple questions in the chat box.
Sure.
From Betty, how far back does the Medicaid go back to recapture the payback?
So there are a couple different answers to that question. So for some benefits, if it's a nursing home benefit, they are going to have a look back period for eligibility of 5 years. But I believe generally when they're looking at a payback period, I believe that they generally ask questions for 10 years. I don't know that they require the payback for 10 years, and there may be somebody that works with the HHR that's on here that may be able to answer that better. But when we receive the forms for estates where a beneficiary has received Medicaid at some point and they are expecting payback, we generally have to report for 10 years.
Okay. Another question, we have a couple more. If a third-party trust is the recipient of retirement benefits after a parent passes away, is that considered income and will it affect benefits?
So it depends what retirement account we're talking about. Generally, pensions are not able to be given to third-party supplemental needs trust, although there is some action to change that. I will say that if you're looking at a 401k or an IRA, you're going to look at the Secure Act, which came into effect in 2020, and that's going to show the eligibility for what the taxability of that is. Generally, it depends if you are leaving it to a beneficiary who had a disability before the age of 26 and they're getting it through a trust, they will be able to stretch that retirement benefit over their lifetime and it be taxed that way. Otherwise, some trusts are on a 5-year payout and some trusts are on a 10-year payout. So it all depends on what type of trust it is, whether it's a conduit see-through trust or an accumulation trust, and whether it is what type of benefit it is and how old the person who passed away was and whether they were receiving the benefit when they died. So I know that that's a really lawyer answer there that doesn't give you a direct response, but that's one of the things that a lot of factors can play into. So you would probably want somebody to take a look at that.
Okay, another question, Renee, what is the maximum amount of money that can be put into an ABLE account? And she says, I know it's $30,000 a year if you're married, but what's the limit? So back to the ABLE account, the maximum contribution from all sources is $15,000 per year. Now, if the individual the beneficiary is working, that amount can be increased by another $12,490. So that would make a maximum of $27,490 annually for the working individual. And I know that she references the married $30,000. So that's tied into the gift tax, and that would be based on the individual that's contributing and the maximum per individual. So it's $15,000 per individual into an ABLE account, contributing if they're married $30,000 before the gift tax would kick in. And then, did you want to add anything else to that, Anna?
No, I think you're right on there.
Okay. We've had a couple folks ask, let's see, I would like a copy. I missed a few of the questions during the lunch hour. So anyone that would like a copy of the PowerPoint, just send an email to wvable@wvsto.com and we'll get you a copy of the PowerPoint. If you're needing alternate format, just be sure that you're including that request in your email. And let me make sure that we haven't missed any other questions. Is there a max? Renee is asking for clarification. Is there a maximum amount? So an individual can contribute up to $15,000, or if you're married, up to $30,000 before the gift tax applies.
I think she's asking how much can be in the account total.
So with Stable, if there is a contribution above the maximum of $15,000 per year, Stable's going to kick that out. They're not going to allow that Stable account to receive above the $15,000 unless it's a working individual and they've identified that within their Stable account. Then that account can receive up to $27,490. So, and that's annually. So $15,000 annually. Before the gift tax kicks in, and that would be per individual. So Renee, does that help to clarify?
Renee, also I would say that 100,000 total is kind of your limit for affecting eligibility.
Yeah, so if for the individual that's receiving SSI, Social Security does recognize, they exclude the first $100,000 from an ABLE account, and then from that point forward, you're looking at that $2,000 resource limit, and that would include from ABLE or checking or savings account. So they just want to make sure that they're not in excess of that $2,000 asset limit. So I hope that answers That's what I needed to know, the $100,000 limit. Yes,
Yeah,
that
and
is
the total,
for the SSI.
Roxanne, correct me if I'm wrong, but the total amount that can be in there is $482,000.
That's right, over a lifetime, and that amount changes. So, you know, for folks that want to keep track of that amount, you know, and as these accounts continue to age and people are actually, you know, depositing the maximum amount per year, you know, it's likely that down the road you're going to see balances like that. But yeah, be sure that you're requesting to receive the newsletters. We keep updates. That's how we communicate any updates that may occur on an annual basis, any changes. We notify folks via the newsletter. Let's make sure that we have not missed any other questions. Okay. Anna, was there anything else that you wanted to add before we close?
I just again want to say thank you, and if anyone would like some more information on estate planning or supplemental needs trust, please do not hesitate to use my contact information to get that information.
Yeah, definitely. Anna's got some great resources that available for folks that are interested in estate planning. Be sure that you send her an email, phone number. Her contact information is in the chat box. We're also going to include the survey link in the chat box at this time. And Anna, again, thank you so much. It's just an honor to have you with us. We hope that you'll join us again down the road when we do another format like this. It's been incredibly helpful. We will have this session recorded and available. Once available, an email will be sent out. I always tell folks that I know enough about trust to be dangerous. And so now we have the resources that you've provided, and of course, your video webinar too for folks to go back and reference as well. So this is great. We included the link to the chart that Anna referenced to in the chat box. It's also available at our website at the resources tab. And again, thanks, Anna. So much appreciate you sharing your time and your expertise with us today. And so before, let's take care of a couple of housekeeping items. For those that are requesting social work continuing ed, just make sure that you've sent WVABLE an email that you're requesting. Include your email address. That always helps on my end. Be sure that your full name is included in the chat box at this time. And also make sure that you are completing the survey in the link that's been provided in the chat box as well. All registered attendees will receive a WVABLE information packet that also includes program information for Disability Rights of West Virginia. Now, we will take a break during the week of Thanksgiving, so there will not be a webinar session next Tuesday. We will pick back up Tuesday, December the 1st at noon for session 7. The title is Luke Stone Illumination Fund, Who Can Benefit? That will be presented by Rebecca Stone. Having a child with a disability does not come with an instruction booklet, and it is important for parents and guardians to learn early on to start planning for their child's future. It is also important for the professionals who guide them to have accurate information, relevant resources, and an optimistic outlook for the child's future. The first portion of the session will focus on practical ways to support individuals with a disability and their parents, guardians, as well as factors that may prevent them from considering future planning. Participants will also learn about the Luke Stone Illumination Fund, the first charitable organization of its kind, focused on recognizing the strength and beauty of the challenges overcome by people with disabilities. Through an essay contest, the Luke Stone Illumination Fund Board of Directors selects a winner each year to receive a $1,000 award made directly into the individual's WVABLE account. You will learn how to access additional information about the Luke Stone Illumination Fund, our recent award winners, and how you or someone you know can apply. So if there isn't anything else, it's been a pleasure to have you all with us today, and you as well, Anna. On behalf of WVABLE and Disability Rights of West Virginia, we wish everyone a safe and happy Thanksgiving holiday break. And we'll see you all in another couple weeks. Everyone take care.